Hi, it's Marissa here from Rise High, and we are bringing you our Adelaide quarterly property market update. I'm here with
Lockie Turner from Turner Real Estate.
and
Brian from Rise High Investor.
and super excited to be with you once again for our first Adelaide quarterly property market update for 2026.
Happy New Year, everybody.
Happy New Year, Happy New Year.
Happy New
Hard to
Year.
believe that January is nearly over. And of course, today we're reviewing what's happened over the last 3 months up to the end of the December quarter in the Adelaide property market and Australia more broadly. I might just turn to you, Lockie, first. How have you found the property market? What is going on? What are you seeing? And then we'll get into some stats.
Well, in terms of the buying and selling market, it is incredibly active. The year has started just like it ended. In fact, the market is more of a continuous market now. I've been doing this for 22 years, and you generally see a bit of a stop over Christmas, which it certainly does. But there's just more properties being marketed over the Christmas period. And then there's some agents thinking, well, I'll just put it online just maybe a week before the end of the year, and then I'll have my opens in the second week in January. But they're getting so slammed that they're having opens 3 days after it's put online, before the Christmas break, and sometimes getting offers. So that theory of just putting a property out there to market it and give it a couple of weeks is probably starting to end just due to the demand. So that's strong. Obviously wonderful for property owners. It continues to be a strong market. I think the problem here obviously with buyers is just the supply. It just continues to be really low. Prices are climbing, as evidenced by the factual data that Marissa will share, but what we're seeing in the trenches, which is the open inspections. The rental market also strong, but certainly settled a little bit. They're not those really inflationary rents anymore. There's plenty of properties for rent. I think it's more of an affordability issue for a lot of people. There's lots of vacant properties for rent, but what the owners are asking is, we're finding just a little bit more regularly, is a little bit higher than what people are prepared to pay. So that's evened out a bit, which is good for the tenants, and the landlords are still getting a good yield, but they're not rising like they were.
Yeah, we have seen, we still have seen growth in the Adelaide market, like you said, across every area. And I think the stats that came out by CoreLogic, 5.1% growth in Adelaide dwelling values over the December quarter. And regionally it was a little bit less, it was about 3.5%. Australia was about 2.9%. So once again, Adelaide still leading, well above the national average. And I know, Lockie, we've been doing these quarterly market updates for a while now, and we've been saying every quarter that we think, okay, well, it has to sort of slow down. And certainly the growth has slowed down from what we were seeing just after COVID, but it doesn't really seem like it's going to stop at this stage. It just seems like we're having the same conversations quarter after quarter. Supply is low, demand is still really strong and really high. What are your views on this and where we're sort of heading with the Adelaide property market?
I think it's a fascinating insight, and perhaps I can put out there and say that this is the new normal.
Yeah,
I think maybe it honestly is, and that might be a terrifying thing for some people. But Marissa, you're going to ask me to share some tips at the end, and I think Brian, you're going to share some really good things on that shortly. But I would say my first tip to get in early would be to say, don't wait for changes in the market. I think some people do that. I've been doing this for 20 odd years, and a lot of people just say, I'm going to wait. Well, wait for what? So what was expected to be sort of 2, 3, 4 interest rate reductions have not occurred. Inflation is stubbornly staying high, which is why the interest rates are where they are. The inflation's gone down a little bit, so we had one drop, but then it's gone back up again. So I just don't think interest rates are going to move very much. What's more volatile is probably the share market. Timing there is probably more important. You can get your money in and out. It's a lot more liquid. It moves up and down daily with the market. Property is just what people want and need. We all need a roof over our heads.
That's right. And
investors are very wealthy. So I think the problem with interest rates and the blunt instrument that it is that there is such insane wealth now from people that have been in the market for 50 years, that have owned property, that have got tens of millions. They're just cycling their money around the market and buying unconditionally. And they're all the people competing against the first home buyers and the people wanting to buy family homes. So that's what's driving pricing. It's just that they've owned property and that's gone up, and they are just buying and selling in their own right. So it's like its own micro market that isn't affected by interest rates.
Yeah, it's a really interesting perspective that you've mentioned the investor, because And you mentioned the share market as well. And I guess, you know, because there is that volatility in the share market, there has been a lot of volatility since COVID and now with what's going on overseas. That are actually a lot of investors are being drawn into the property market because they just feel more comfortable with the stability of the growth, and that is obviously, you know, lifting prices as well,
So,
because
yeah.
people see the demand for investors.
And investors are very active. We're consistently adding 30 to 40 new property management landlord clients a month at Turner Real Estate. And that's just
Amazing.
our agency. So I say that just to say that's just our agency. So they're active. You know, the Adelaide market's gone up 2.5 or 3% more than the national market. Why? Is because people can still see value here, in terms of purchase price. Plus, also they're getting the yield, and it's a very livable city. They can see that we're like Melbourne 10 years ago and Sydney 30 years ago, and so they're very keen on the Adelaide market, which is driving it. I think the other issue that's driving prices, which Brian, I'll hand over to you, are the government incentives. So they're all good for first home buyers, but what they're really doing is just driving the demand, and therefore prices are going up even more with anything like that. So
Yeah, I guess like with people getting into the market, right? Whether it's, you know, a first home buyer or an investor, like especially for a first home buyer here in South Australia, I think we're one of the only states that have a lot of government incentives, and all for the right reasons, right? The government is trying to help first home buyers enter the market, but you'll probably agree with me that, you know, on one hand they're trying to help the first home buyers, but on the other hand the property prices are being pushed up as well. So I think like with the two main, I think, government changes that recently came in was the first home guarantee scheme, where they've increased the cap from, I think, 650 to 900 now, so that automatically moves every property within that price bracket upwards. And then you now also have, I think with Bank Australia and Commonwealth Bank, they've come out with a shared equity scheme as well. So previously here in South Australia, you're only limited to using Homestart, which offer the shared equity scheme, but now it's open to mainstream lenders as well. So that helps a lot more people get into the market. You don't have to show, you know, serviceability on the shared equity scheme, and that goes, the government can put in between 30 to 40% of a property value. So that's a lot for someone that's not able to borrow that money to get into the market. And with like, there's just so much more demand for people buying a home, whether that's a first home buyer or an investor.
So that probably, you know, obviously the government's trying to do the right thing. They're trying to help first home buyers that don't have the deposit. They're trying to help first home buyers that don't have the affordability. But really the end outcome for the property market is that all properties valued under 900,000, let's say, are just being, you know, the demand on those is just increasing rapidly. And as we know, with demand and supply, when we have a limited supply, which, as you said, Lockie, is still low compared to historical averages, and we have a growing demand, that's what lifts prices up. So in one way they're helping, in another way they're making it harder.
Well, they're just adding to the problem. Like they're like the government, with respect, doesn't really know what they're doing in that regard, because what they're doing is just adding to the demand. They're just giving people, you know, the capacity to be able to compete better in an open marketplace. So look, I think we just go around in circles as a people, as a society with this issue, but really it is supply, and that's what the governments and state and feds are working hard on, and that is really the solution, is just the supply. And look, I think the problem is the lag time in until the land is released and developed and built and so on. So, you know, that's probably was 5 years now, it's 3-4 year time frame, but it's still a while away. So
we might be better off if the government was investing money instead of into these schemes, maybe incentivising developers to build more houses quicker. But then I guess we do have limited
I think the
resources.
state's changed a lot of the zoning legislations within the metro area, essentially being that allotment sizes now that you're allowed to build on are much smaller. So they used to be very restrictive, had to be like 500 square metres minimum or 700 now, a lot of areas. And like you might live in one suburb and there might be 3 or 4 zonings just in that one suburb. And it can differ quite a lot, but now they're allowing a lot smaller allotment sizes to build on. So infill is huge. That's why you're seeing a lot of high rises around Adelaide. There's a lot of debate around that from people that live in established areas that feel like they're being looked over. It's happening a lot in Melbourne as well. So these things are a sort of a good thing in a way, because we're using existing infrastructure to build denser housing and more of it, which is good. There's a lot of land north and south all being cut up, all farm area, all being divided and built. So 800 new homes that should be finished this year at Aldinga Beach, which is called Villawood. Magnificent part of the world, that's brilliant. And there's another 1,000 being built down there as well, with more farm area being cut up. So all these things are helping, and I think the supply is the issue. So I think that's really where the resources should be aimed at. But I guess they're trying to help people now because there's a lag time with that stuff being built. So it's a very difficult social situation, really.
Yeah.
I like the shared equity though. I think that's brilliant. Can they talk to you about that, Brian?
Yeah. So definitely
Do you want to explain a little bit more about what the shared equity is and how that works?
Yeah, so for the shared equity, basically the government owns a percentage of your property. Now, you may be able to borrow 500 grand and that probably gets you as far as a unit here in South Australia, and that may not be what you're happy with. The shared equity really is the government putting in between 25 to up to 40% if it's a brand new home here in South Australia, where if it's a 500 grand property, I'm trying to do a quick math on my head, but that's about 200 grand of shared equity that the government could put in. So all of a sudden you could be potentially looking at upwards of 700 grand of a property to get into the market. And the good thing about this shared equity, I guess, is that you don't really make any repayments on it. It's interest free. I guess where the government makes back in terms of their investment is that if and when you do refinance out or you pay out the shared equity, they get the percentage that they own in terms of the growth of that property. So if that
the government shares in the growth of the property with you. So if you sell the property for a profit, or if the property goes up in value, they get a share of it.
Correct. And I guess that's just their return on investment, right?
Yeah.
But I guess...
Well, that's really fascinating because being a real estate agent, there's a whole nother market that we're not aware of, which is the off-market market, which is like the undercurrent of all the stuff that goes on. So that'd be fascinating. And sales between family members, which is lovely. I mean, if you can do it, parents sell to kids. But if there's this 20% ownership by the government, how does government feel about that? Because they'd probably want to see market value if
it would have
exchanged.
to be at market value.
So that's going to force those. So there must be rules around that. There must be rules around what the government asks for once it does exchange or sell. I would imagine. But by the way, I don't think it's a negative thing. I think everyone who owns an asset, particularly a property, and I sound biased, but I'm not. You should sell anything in an open market if you want to get the best price. Obviously aside from helping family and friends and so on. So that goes for selling something on Facebook Marketplace. You're selling a scooter and you want $50, you should probably put it out there. If you want to do that.
So Brian, what else are you seeing impacting investors at the moment, either positively or negatively? What are you seeing in the investor space?
Yeah, I think in the investor space, what's really changing, and in terms of an investor strategies, really lending for an investor has changed significantly over the past 6 months. I guess ASIC and APRA are all cracking down on a lot of unregulated investment lending. Investment lending has picked up significantly over the past couple of years, and that's just because, like going back to your point, confidence in the market. A lot of investors are really wealthy. They think that this is just child's play. Let's just buy properties, and there's a lot of methods of getting into the investment market or getting investment lending back then. But they're making it much more harder. They're going to be regulating a lot of investment lending. That I guess they're going to basically put a microscope against investment lending now. I think one of the main things is that your debt to income ratio against your entire portfolio. Most banks are kept by 10% in terms of their portfolio now. They can't go above 6 times your debt to income ratio. Trust lending, company lending, that's a very popular space that the government is looking at as well. A lot of banks are changing their policies around that, so it's not as easy as going to get lending in terms of a trust or a company entity anymore.
So you have to be a bit more strategic if you're an investor, because moving forward, the government is getting a bit nervous about how many investors are, or the level of debt going out to investors as a percentage against owner occupiers, and is putting down the reins from what you're saying. So that means that investors have to be a bit more strategic, a bit more clever in terms of how they move forward. Are you still seeing good opportunities for investors in the market, despite these tighter lending or more difficult lending regime?
Yeah, I think in terms of opportunity, there's always opportunities for an investor. It's just going back to your point, right? You just have to be really strategic in terms of it. You really need to understand the lending side of stuff, the portfolio planning side of stuff. You have a really good accountant, have a really good property manager, just really having your A team right there, to really, so that all of us can provide you, a holistic advice in terms of you building your property portfolio. But yes, opportunities are always out there. You just have to make sure that you have a strategy that is tailored to your specific circumstances, not someone else's strategy out there.
I think what I am hearing here is that banks want to lend money, right? They have to lend money.
Yes.
The third party of APRA and ASIC are coming in and just trying to instigate some guardrails. I think probably what we're saying here is that for 99% of the population that borrow money for investment, they do it in a very honest and simplistic and straightforward manner. I would say a lot of what APRA and ASIC are doing are actually targeting the really, really highly geared and very tricky little ownership structures and shelf companies and things like that. I would say they're the people they're probably having a bit of a look at. I'd say for 99% of the population, that's fine. Like banks want to lend you money. That's how they're publicly listed. So that'll keep happening, and that won't be a problem. It's for people that want to push the boundaries on structures that are probably going to get a bit more of a look at.
And that's a good thing, because one of the first things that when a client comes to us in terms of building a property portfolio is that we need to make sure that the cash flow is well mitigated. If interest rate rises or interest rate reductions and everything, your cash flow is really well safeguarded, regardless of what the market does. So what ASIC and APRA is doing here is really, I think it's the right thing, it's the right step, because there's just a lot of cowboys out there, I guess, doing lending, unregulated. So yes, like to your point, exactly.
And that's good for, like I said, 99%, because then it makes the playing field more even, and that's the type of society that we want to live in. So certainly applaud that aspect to it. Yeah.
But I think in terms of any type of investing, there's rules to any game, and investing is a bit of a game. There's rules to the game. If you just go and borrow money without really thinking about the future or the long term, in terms of what is the long term goal and having a bit of a plan towards that, you can enter into the wrong loan or the wrong lending structure that will then limit what you can do in the future.
Yep.
And I know that's one of the things that you spend a lot of time helping investors to understand and navigate through. Are you still seeing that? I just feel like with the tightening of the rules, it's going to be even more important to be strategic about your borrowing and make sure that you're not just borrowing money with the first person that, or you actually having thought about how this purchase, this loan will impact your future goals and plans. Are you seeing that will be more important in the future, Brian?
Yeah, no, that's the bread and butter as to what we do. Like what we tell our clients is that when you're building a strategy that's tailored to you, you actually need to know why you're actually making certain decisions, or all the decisions that you make that actually brings you one step closer to your goals, not one step further. Because I guess with a lot of investors, or investing in general, you can sometimes be really short-sighted as to what's the best I guess outcome is in the short term.
Just thinking about the current transaction, whereas it's much better if you think about the long term of where you want to be in the future.
Yeah, so in a practical sense, I guess to summarise, is you've got to have the cash flow to fund it in worst case scenario circumstance. And I think the main thing about when you're trying to plan your portfolio is ownership structure of that entity. That's the big one, because being in real estate, any change of ownership attracts stamp duty, which is like 6%. And then the other main key thing people think about is tax. So should I own it in a company, a trust, or an individual? If you buy investment properties in a trust, that attracts land tax from $0 upwards, whereas if you buy it in your own name, it doesn't. So there's all those sort of things just to look at. That's all on the websites anyway. You can just go to the Revenue SA stamp duty calculator and all those sort of things and see it all there. There's probably ownership, cash flow, and then just your tax
strategy
situation. But you don't want to change ownership because that attracts a 6%
on top of stamp duty,
the value of the property.
Capital gains as well, like if you are changing ownership. So not just
well, look,
duty.
that we've probably run out of time. We had a lot that we could all talk about today, but that's all for our January 2026 Adelaide quarterly property market update. Thanks for tuning in, and we'll see you again in 3 months for our next quarterly market update. Thanks, and have a great day. Bye.
Thanks everyone.